This is your LMAX Exchange technical update for Tuesday, January 31st, 2017. Euro dollar. So if you look at the euro right now, we're continuing to see this correction out from that 14-year low in January at 103.41. And really, the correction is still in play as the market was very well supported into loose channel support in Monday trade. So we could still see this market try to break higher in this correction, extend up into the 108 area. Of course, 108.75 is that critical level of resistance above that represents the December peak. And so a break above there would really be required to potentially force a more significant shift in the structure. Until then, there is risk, of course, for this market to stall out in favor of the broader downtrend with a lower top and fresh downside extension. So right now, again, we're in the middle of this correction, or we're in this correction right now where the market's been supported within the channel, so it could continue. At the same time, we're getting up to some key resistance where the market may want to stall out in favor of a resumption of the downtrend. So it's a wait and see right now with the euro. Key levels to watch above and below. Right now, above comes in at 107.75, and below the low that we saw going back to the 16th of January, which comes in around 105.79, 105.80. Those are the key levels right now to watch above and below with the euro. Sterling dollar. So cable has recently traded up towards some critical resistance at 27.75, but inability to take out that level or to challenge that level keeps the immediate pressure on the downside, with the market potentially rolling back over towards those meaningful lows, that plus 30-year low that we saw in October of 2016, and that recent low this year just shy of there in the 119s. So again, the risk does remain to the downside while the market is stalled out ahead of that critical high that we saw going back to the 6th of December at 27.75. Dollar yen. So dollar yen continues to chop around, but there is risk for this pullback that we've seen off the multi-week highs at 118.67 to continue. A break below 112.52, the recent low, will strengthen that outlook, of course, and accelerate declines down towards the 110 area further down, at which point the market should ultimately look for a higher low in favor of a resumption of what is now a broader uptrend. Again, we could still see setbacks in this market into the 110 area, even a little bit below, but at that point, the market should look to put in a higher low ahead of a resumption of the broader uptrend. Euro Swiss. So Euro Swiss continues to be under pressure. The market has accelerated to the downside in recent trade, and this puts the focus on a retest of the 2016 low at 106.24. A break below there would expose psychological barriers at 105 further down, but clearly the downside pressure remains intact, and it would take a break back above the 107.60 area to take the pressure off the downside. Aussie dollar. So Aussie is stalled out in recent trade above 76. This could be suggesting that the market's ready to roll over in favor of a resumption of declines. Overall, this is a choppy market that's been very well supported into rallies, but well capped into rallies and well supported on dips. And as we get up into the 76 to 78 area, there is risk again increasing of the market stalling out in favor of a resumption of declines. Dollar CAD. So dollar CAD is traded back down towards some major support in the 130 area, but while the market holds above 130, there is risk for this constructive outlook to remain intact and for the market to push back higher towards the recent multi-day highs in the 136 area. Only back below 130 would compromise the immediate bullish outlook. Kiwi dollar. So Kiwi hasn't really shown signs of rolling over just yet, but it has stalled out above 73 in recent trade, and the market does look like it's topping out in 2016 after stalling just shy of 7,500. So there is risk for Kiwi to roll back over, but again, we need to see confirmation with a close below some recent support, which comes in around the 72 area. A close below 72 would accelerate declines and open the door for a resumption of declines back down towards below 70 and into the 66 to 69 area. SPX 500. The S&P 500 is stalled out by fresh record highs last week just above 2,300, and at this point there is risk for additional declines. However, we would need to see a break below 2232 to take the immediate pressure off the top side and suggest a more significant top is in place in favor of a potential structural shift. Again, until a break below 2232, the risk remains on the top side, and we can't rule out the possibility of additional record highs beyond the recent highs just over 2,300 in the 2304 area and towards 2320 next. Gold. So gold has seen some pullbacks over the past few sessions, but again, the market has been very well supported on dips. Overall, it does look like this is a market that's trying to put in a longer-term base after stalling shy of 1100 back in 2016. Look for the market now to be very well supported ahead of 1160 in favor of the next upside extension beyond recent highs in the 1220 area and towards the 1250 area further up.